Welcome back to the channel, guys. It's time for me to review the final basket from the new release from IncomeShares, which is the Artificial Intelligence Leaders one. So this particular fund looks at AI growth and generates these high monthly yields from it. So the idea is that we can get steady cash flow from companies that focus on artificial intelligence and are typically leaders in that space. So we're going to go into the yield, we're going to go into performance potentially, we're going to look at the underliers that are in here, the usual pros and cons. I'm going to give my perspective on it as well. So let's jump straight in. So distribution yield. So we actually have our first distribution. So the two that I previously covered, we hadn't had the announcement yet, but this one we have. So we know it's at 16.12%, which is a pretty good yield. But just bear in mind, the first yield figures always take a little while to settle down. Whether this will be the long-term yield, we'll soon find out. In terms of a structure perspective, it is a basket of leading AI stocks. We will talk about the weightings as well in a second. It is rebalanced semi-annually. Same caveat, I would argue, for the other ones, whether semi-annual's going to be enough. I think I would have preferred quarterly rebalancing, to be honest, but just because of the volatility of the nature of what's happening in this space right now. The distributions are monthly, expense ratio 0.45%, released fairly recently, and it is domiciled in Ireland. It is UCITS eligible, it is SIP eligible and ISA eligible, but funding report status is still pending. I wanted to give you some kind of view, like I always do. Now, take this benchmark still with a little bit of pinch of salt, because obviously it is a broad index benchmark and it isn't a like-for-like comparison perfectly, but it's as close as we're probably going to get. I've picked the iShares AI Infrastructure UCITS ETF, which posted an explosive gain of 45 to 55% over the last year. And if I was to, what I tried to do was I tried to take the strategy that is IncomeShares, look at the blended kind of balanced load across all of the different stocks, and try and look at what that might look like. So from a growth perspective of about 35%, you're trading off some of that growth for the yield. Now, it probably will end up being less than that in comparison, but the yield may be slightly more. I don't know. Again, I just wanted to pick a benchmark to give myself some clue, but we know that obviously these income funds are capped on the upside. So when there is more volatility in that stock, potentially they lose out more on the gains. Okay, if we look at this from a valuation context, now the reason I put this in here is because I wanted to address why I'm not going to probably buy this fund. And I talked about the semiconductor one, which I was more interested in. And I wanted to elaborate on why. Now, some of you know that I also have a bit of a value investing background, not just an income investing background. I know, again, people in the Discord have asked me, can I cover how I would look at things from a value investing lens? But I always apply some sort of lens on what I buy in terms of value, even though it might be income focused, which is why I'm buying it. But I thought this would be interesting for some people to look at. So there's two crucial measures that I picked out here. Now, these aren't the only measures I look at, but these are probably the easiest measures to look at from a starting perspective. The most common one that gets used a lot is what's called price to earnings, or PE ratio. And this measures the current share price relative to the per share earnings. So a higher PE generally indicates that investors are willing to pay a premium now because they expect massive earnings growth in the future. And it's a hallmark of the AI and semiconductor space at the moment. Another metric that I think is slightly more balanced maybe is price to sales, which compares a company's stock price to its revenues now. This metric is especially crucial for evaluating high growth infrastructure companies that are investing heavily to build out AI capacity, showing how much the market values their top of the line expansion. So you can look at these two metrics in parallel. They don't have to be looked at independently. And there are other metrics, of course, that are just as important, but I didn't want to make this video about valuations and too much around that, because ultimately it's an income investment. But just to give you an idea, so the iShares AI Infrastructure basket, or UCITS ETF, Its PE is somewhere around 23.6 to 31.4%. Its trailing PS ratio is 4.5 to 6x. Now, if we compare that to three other indexes, the tech-heavy QQQ, which, to be honest, is fairly closely aligned to the infrastructure AI as you'd expect it, but it is still slightly higher, 33.4 to 34.3, and the PS ratio is much higher, 11.2 and 12. And then if we look at the S&P 500, the PE is probably arguably on the lower end compared to the AI infrastructure, so 25.4 and 27.3 with a PS ratio of 3.2. So the thing to note is this AI infrastructure kind of sits in the middle between a QQQ and an SP. But what I find most interesting is if we start to bring in one closer to home for me anyway, which is the FTSE 100, we can really start to see the gaps. If we look at the PE ratio, for example, it's 16.2x to 17.6x, and we can see the PS ratio is very low at 1.1x. And I think this is why we saw a resurgence in the FTSE recently, because it ultimately is, in my opinion, personal opinion, undervalued. And eventually valuations start to come through into the market. Short term, they always say it's a voting machine. Long term, it's a weighing machine. And I feel like that's what's happening here. My concern with the AI space is less potentially around a bubble per se. And there could be one, don't get me wrong, there probably is one. But I'm more concerned by the fact of the valuations are quite high. And I'm thinking, are there better things out there a bit more safer? Now, you could argue this is an investment play and you need a bit of volatility to get your money out. But as I said, I'd probably put my bet on the semiconductor space than the AI space. Now, saying that, I want to start to look at the holdings. And I think this is where things start to change a little bit from a dynamics perspective. And if you're liking the video so far, guys, don't forget to hit the like button. Don't forget to subscribe if you haven't already. We're still trying to target that 1,000 subscriber mark by the end of next month or this month if we can do it. So what makes it interesting is a lot of the tickers that are based in here, you probably already got somewhere within your portfolio, within another basket potentially. So for me, for example, I own the FTSE All World, VWRP, and that has probably all of these stocks in it. It's a basket of over 3,000 stocks. What I do like about this is that it is equally weighted amongst all of the holdings. So there isn't a particular outlier within that mix. Now, that doesn't necessarily mean there isn't an outlier in terms of the returns, but there is no outlier in terms of the actual equity. And then obviously there's that rebalancing that occurs semi-annually. But when we look at the actual holdings, let's start to dig into this because I really want people to have the concept around really understanding what they're buying into, not only from a strategy perspective, but also from a company perspective. A lot of the time people are quick to criticize when, things go down versus when they go up. But I think a lot of the time it's because they don't always follow the detail of what they're buying. They follow the hype, they follow the yield, rather than truly understanding the companies that sit behind what's generating that yield. So I want to cover these. So if we start with AMAT, again, it's Applied Materials Inc. It's a leader in materials engineering solutions used to produce advanced AI chips worldwide. We then have LRCX, Lam Research Corp., global supply of innovative wafer fabric equipment vital for high bandwidth AI memory. Now, it's interesting, some of these in here are also in the semiconductor basket, by the way. We then have Marvell Technologies Inc., premier data infrastructure provider specialized in critical AI network and storage components. We then have Palantir. Now, Palantir is actually the IncomeShares version of the Palantir, but it's basically dominating the defense and enterprise AI software sectors. We then have Qualcomm, which is a pioneer in wireless technology driving the future of on-device edge AI processing. We then have GUI, which is the IncomeShares Alphabet options, which is, as we all know, Alphabet, Google, leader in generative AI models and cloud infrastructure. We then have Analog Devices, leading high-performance analog technology, bringing the physical world with AI compute. We then have the IncomeShares Amazon options, which we all know Amazon, the world's largest provider of scalable AI cloud computing, along with many other things. We then have CoreWeave Inc., which is a specialized cloud provider engineering specifically for massive GPU accelerator workloads. We then have the IncomeShares NVIDIA options, which again is based on NVIDIA, which is probably at the moment the undisputed leader in the AI accelerators and GPU space. We then have Texas Instruments Inc., which is a stalwart manufacturer of analog and embedded processing chips vital for industrial tech. We then have Meta. Again, it's the IncomeShares version of it. So this is obviously a pioneer in open source AI and massive infrastructure. We then have the IncomeShares Microsoft options, which again is based on Microsoft, driving massive enterprise AI adoption via Copilot. We then have Super Micro Computers Inc., which is high performance, high efficiency servers and storage solutions for enterprise AI data centers. And then we've obviously got the cash within the fund. So let me know what your thoughts are on the actual underlies within this fund. Now, as I said, there are some crossovers with the semiconductors. Does it make sense to own both? Only you can answer that question for yourself. I know some of you may even have the individual tickers for some of them that are in here as well. So again, you have to manage your own exposure and doubling down and things like that as well. Let me know in the comments, by the way, actually, if you're planning to buy both of these. I'll be curious to see if anyone actually is planning to buy both. Okay. As always, talking about the strategy, obviously the biggest advantage is what they're designed for, which is monthly cash flow generation, getting that reliable distributions from monetizing the volatility of the AI assets. There's obviously the concentrated sector exposure, however, linked to AI and cloud. You have, however, got a equally weighted model, so that's great, and it is rebalanced. And it is very cost efficient. Again, this is one thing that I've been impressed by with IncomeShares is they've kept the expense ratios very competitive. However, flip side, limitations. Obviously, it is still capped in bull markets. There is partial downside protection. But again, with the hedging now and them restricting the amount of distributions they give out, we could argue that this is going to get better. But the trade-off is that they are deciding how much to keep back. And there's obviously the structural complexity always involved in option strategies. So from a final verdict perspective, perfect for investors who refuse to choose. If you want a disciplined approach to the AI boom while generating consistent monthly income, this hybrid ETP is built exactly for you. As I said, my personal view on this is I do like the fund in general, but I'm concerned by the AI valuations. You could argue this could be a good hedge if you are willing to say, I think we're in AI boom and I want to take advantage of the volatility of it using the option strategy. For me personally, I think the semiconductor is a more prominent market because everything has just got semiconductors in them or chips in them nowadays. So I feel like that is quite an untapped market and quite a growth market from a personal perspective. So hopefully this was useful, guys. Let me know in the comments on your thoughts on this particular fund, and I will catch you on the next one.